Hello, and welcome to Pro Trader Strategies Market Commentary for Tuesday, December the 29th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Only bit of economic data that we really got here in the U.S. was consumer confidence, and it came in at 96.5, and it was expected around 94, or I think it was 93.5. So just so you guys know, that came in a lot higher. So the consumer is confident, which bodes well for spending and things of that nature. It could be because nobody got in fights at the Christmas get-together, so the families aren't fighting and they're feeling confident. No, I don't know if that's true or not. Just kind of a joke about that. But anyway, moving on. As you can see here, NASDAQ pushing higher by 66.5 points, very close to the highs of the day. The market just really came back yesterday strong after being down quite a bit and settled above this value area, which means the bulls are in control. Moving higher. Anyway, so same with the E-mini S&Ps. As you can see here on this chart, they're up 18 points or so, created this value area high here and bumped up against it several times. But once it broke through this value area of the last several days, that's really when you know that the bulls are getting control as well. So you can see that there. Moving on to some things I took off. The one thing that I took off here is in Qualcomm. I put this on around December 10th, and I had on the January 47.48 put spread, and I originally got a credit of 33 cents for doing that, and with today's pop I was able to cover that back for 13 cents. Better than my better than my 50% of max profit, but because I got it inside that max profit area, I took it off, and we have a really nice pop there today. So it's not worth holding on to this trade for another 10 days and collecting another 10 cents. I already collected 20 cents out of it, so it's just not, the risk reward is not there for me. All right, so that was a trade that I took off. Trade that I added was in Nike, I was looking to do Nike, but the spreads or the bid off ask is really wide, so I didn't want to get in there because they're getting ready to do a stock split, so I decided against Nike. But I went into Apple, and I did a long call spread because in Apple, as you can see, the volatility, implied volatility percent is really low. This is the current implied volatility. I think it's around 20% on the IV percentile. So this is the time where I'm going to be looking to buy options. Anytime it's below 50, that's when I look to buy options. If it's above 50, that's when I look to sell premium and sell those option strategies. So with Apple, it's gotten beat up over the last few days. As you guys know, I was short this move here and got out a little too early, but we're kind of found a bottom here, and it looks like it's ready to come back. So in Apple, I did the February 97.5 115 call spread. So I bought the 97.5 calls, which is below the market in the money, and I sold the 115 calls, which is right up in here, and I had to pay a debit of $10.44. So it seems like I paid out a lot for this strategy, but when you look at the intrinsic versus the extrinsic value on these, the extrinsic value actually made it to where I got a little bit of credit. So, I got this for $10.44. I paid on the 97.5 calls. So Basically, I paid 108 for it, so I got it, somewhat like 50 cents below the market. So, or it's probably more closely to 25, 30 cents below the market. So the market's gone up since I put this strategy on. And I'm going to be talking about how to create this. We've done several on the collars. This is kind of another way to do a synthetic collar if you aren't really long the stock. The same, if you're doing just a lot of option strategies, this is synthetic collar, if you will, when you don't own the stock in particular. It's got the same risk parameters, the max profit, same max loss parameter, probability of profits right about the same, and the difference is I don't have to lay out for 100 shares of this, $10,000. So it's closer to $1,000 for the margin requirements. So that's a big difference on a smaller account, or even somebody that likes to trade a lot and have a lot of different things going on in their account. So this is going to be a great strategy for that. I hope you guys can all make it there. It's going to be tomorrow because we are having the holiday on Friday, so that's usually when we do this strategy. And because of that, we're going to do it a little bit earlier. Thursday's probably going to be a pretty quiet day, so Wednesday works out really well for everybody. All right, that's all I got for you today. If you can't take that, take it easy.